When you think about the real foundation of the American economy, what pops into your head? The tech giants, the big banks? Well, today we're talking about the company that provides the literal foundation, Vulcan Materials. It's not flashy, it's not glamorous, but it is the bedrock that almost everything else is built on. So, let's get into it. Okay, let's start with this number, 16.5 billion tons. It's so huge it's almost meaningless, right? I mean, to put it in perspective, that's like the weight of more than 30,000 of the world's tallest skyscrapers combined. But this isn't just a random giant number. It represents Vulcan's single greatest and maybe its most misunderstood asset. And this is what we're talking about: permitted aggregates reserves. It sounds technical, but it's simple. It means Vulcan has the legal right to dig up 16.5 billion tons of stone, sand, and gravel, the basic ingredients for everything. And here's the absolute kicker. Because of insane zoning laws and environmental regulations, trying to get a permit for a new quarry today, it's next to impossible. Vulcan owns a treasure chest that no one else can build. So here's the thesis for us as investors. Vulcan Materials isn't just some company that sells rocks. You have to see it as a powerhouse, sitting inside a fortress with massive, impenetrable walls in an industry that's basically set up for the leaders to just keep winning.
So to really get our heads around this, we're going to break it down into 4 key parts. First, we'll dig into that unbreakable business moat. Then we'll look under the hood at their profit per ton machine. After that, we'll talk about the huge infrastructure wave they are perfectly positioned to ride. And finally, we'll wrap it up by weighing the price, the promise, and of course, the peril of investing here. All right, let's jump right into Section 1, the unbreakable business moat. This is all about those built-in advantages that shield Vulcan from competition and basically ensure this business is built to last.
The first thing you absolutely have to understand is this: selling aggregates, rock, sand, gravel, it's a local game, period. This stuff is incredibly heavy, which means it's incredibly expensive to move. You can't just ship a ton of gravel from overseas to undercut the local guy. It's not economically possible. This simple fact of physics creates a natural barrier against global competition. The quarry closest to the job site almost always gets the business. So you might be thinking, okay, why not just open a new quarry right next to Vulcan's? Well, good luck with that. Just look at this process. First, you have to find the right land. Then you have to survive years of public hearings and zoning battles. We're talking angry neighbors and red tape for days. Then you've got to navigate a maze of environmental permits. It's a brutal, expensive, multi-year gauntlet that almost nobody can get through. And what's the result of those insane barriers to entry? Total dominance. Because new competitors can't break in, Vulcan has locked up the number 1 or number 2 spot in a staggering 90% of the local markets they operate in. And you know what that kind of local dominance gives you? The holy grail in business: pricing power.
And that pricing power leads us straight into Section 2, the profit per ton machine. See, having a great fortress is one thing, but what you do inside that fortress is what actually makes you money. And this is where we need to talk about the Vulcan way.
The Vulcan way is a really smart, disciplined strategy. They're not just trying to move more rock. They are obsessed with focusing on price over volume. They use data, technology, you name it, to squeeze every last cent of profit out of every single ton that leaves their property. It's a huge shift from just selling a commodity to being a highly strategic, value-driven business. And hey, don't just take my word for it. The numbers don't lie. Look at this table. This is their cash gross profit for every ton they sell. Just follow the trend. It goes from about $7 in 2020 to a projected $10.61 in 2024. That's not just slow and steady. That's a serious acceleration in how much money they make per unit. This chart makes it even more obvious. Just look at that jump from 2022 to 2024. That dramatic double-digit growth is the absolute core engine of this company. Even if the total amount of rock they sell stays flat, their earnings can still soar because they're making so much more on everything they do sell. Okay, so we've got a protected business that's getting more and more profitable. So what's the next chapter? That brings us to Section 3, riding the infrastructure wave. This is the big catalyst, the tailwind that could push this business forward for years. What's happening in the market right now is fascinating. It's like a passing of the baton. For a while, the big driver was residential construction, building houses. But that's sensitive to interest rates, and it's cooling off. But stepping right up to take its place is a massive multi-year wave of public infrastructure spending. And the best part? It's federally funded, so it doesn't really care what the Fed does with interest rates. And the fuel for this whole wave is this monster number, $1.2 trillion. That's from the Infrastructure Investment and Jobs Act. And this isn't some theoretical number on a piece of paper. This is real cash, already allocated to build and fix the very things that use millions of tons of Vulcan's products. Roads, bridges, airports, you name it. And you want to know why Vulcan is pretty much the perfect company for this moment? Get this, a whopping 67%, 2/3 of the highway money is going directly to states where Vulcan has major operations. Their quarries are literally sitting in the path of progress. It's no wonder their management team is already telling investors to expect shipment growth to kick back into gear in 2025, thanks to all this spending. Okay, I know, the story so far sounds almost too good to be true. A protected monopoly-like business cranking out more profit with a giant government-funded boom on the horizon. So, what's the catch? That's what we're going to tackle in our final section, weighing the price, the promise, and the peril. And the catch for a lot of investors comes down to one thing, the price tag. If you look at its valuation, Vulcan is trading at a price-to-earnings ratio of around 42. Now that's a pretty hefty premium compared to its main rival, Martin Marietta, and it's more than double another peer, Eagle Materials. The market knows this is a great company, and it's definitely not on the bargain rack. So let's just quickly recap the bull case. You get the undisputed market leader with a fantastic moat. You have a business that has proven it can make more and more money per ton year after year. It's the #1 beneficiary of a once-in-a-generation infrastructure boom. And on top of all that, it's perfectly located in the fast-growing Sunbelt states. It's a pretty compelling story. But you have to look at the other side. The bear case is real. This is still a cyclical business. A bad recession will hurt. And that high valuation? It means there is zero room for error. They have to execute flawlessly. Plus, you always have risks, like a bad hurricane season, shutting down quarries, or a big acquisition that goes wrong. These things can't be ignored. Which really brings it all down to this one final, critical question that every investor has to answer for themselves. We know Vulcan is a best-in-class company. We know an infrastructure supercycle is just getting started. The question is that premium price you have to pay today worth it for the promise of growth tomorrow? That's the multi-billion-dollar question you've got to decide.